If you've missed it, we have some breaking news this morning. The unemployment rate for last month, 6.2%, ticking up there from 6.1% in June. And we also got 209,000 jobs created in the month of July, a little shy of expectations. But the prior month jobs created was revised upwards by about 10,000 to almost 300,000 jobs. We're joined now by Tony Crescenzi. He's Pimco Executive Vice President and Market Strategist. He's here on the set. We're very privileged. Thanks for being here.
Thank you very much.
What do you make of all this?
Well, Janet Yellen is focused on the amount of slack that exists in the economy. She spoke before Congress.
And slack is unused resources.
Unused resources. Now, what we saw in the report, and the reason why the jobless rate increased, is because many people decided to discourage workers to say, let me come back. Things look good. I want a job now. Perhaps before they were discouraged and thinking I couldn't find one, so now they're back. She's depending on this to keep wages down, but she doesn't want them to stay down, and that's the disappointing part of the report, that wage growth was unchanged, and inflation, as you pointed out before the break, is
more than unchanged.
Which means real wages, what Americans are taking in after inflation, is actually was negative during the month, and that's not good for Americans. And so in terms of Fed policy, it seems they'll be able to be patient on rates and not want to.
So the cost of borrowing is going to stay low for
so the timeline for a rate hike right now, based on markets and what the Fed is saying, is mid-year 2015. That timeline is intact, but it could push out if wage growth does not accelerate. Now, one important point, in March, the Fed, in its minutes, the Fed has minutes to its meetings that sum up what was said, and they're released 3 weeks after meetings. It said that when wages begin to accelerate, it would show the Fed that labor market conditions were returning to normal, meaning that everyone that wants a job could have one, and that wage growth would then accelerate and help Americans in there.
And I love the idea of normal, because it has been so long since we've had a, quote, normal market, that maybe this is the normal. On the investment side of things, are bonds still a good investment? I know a lot of people have been in bonds, junk bonds, corporate bonds, treasury bonds. What do you think? I know you're like you're the king of bond houses.
Thank you. Barclays Aggregate, which is what many bond managers judge themselves and others judge them against, is up about 4% for the year. It's sort of like the S&P for the bond market in terms of how to judge how the market's faring. So up 4% for the year. And other bonds some bonds are faring better. Riskier ones are faring better for the year. They always have a place in a portfolio because they help protect you. And so if you want to take risk in a portfolio, buy stocks. You're enabled. You can get in the car and drive because you know you have insurance, something to stabilize a portfolio in unstable times, as was very apparent this week because the stock market didn't fare well, but the bond market has. It's held up fairly well. So it looks like returns will be positive for the year, and they're doing what they should do in portfolios and help stabilize them.
Great. Well, stay with us, Tony. I want to bring back Phil Izzo, who's had a further dive into those numbers, and you know he loves it. Phil, what did you find?
Hey, Simon, I think the bottom line with this report is that even though it was a little bit below expectations, it's all around good news. We averaged $245,000 jobs so far this year. 209,000 is really not significantly statistically below that, and things are looking good. We're not seeing signs of significant acceleration, but we're not seeing signs of deceleration either. It looks like there's a steady stream of job growth for a couple of months now, which is something that we've been waiting for in this economy for a long time.
Okay, thank you very much, Phil Izzo, economics genius here at the Journal. And Tony, one of the things that's been absent from this recovery, and maybe recovery overstates it, but because it's been very, very slow, has been the housing market. Do you think with more jobs being created, 6 months of 200,000 plus will actually make a difference to that?
It should help, because the two pillars of housing are confidence and income growth. And this week, the Conference Board released a confidence survey, the best in about 8 years. And so confidence is a little higher. Income growth, though, even though it's picked up a little, hasn't picked up a lot because wage growth is so anemic. Average hourly earnings are up just about 2% year over year. Historically, they grow about 3%. That doesn't help a household to make a decision to purchase a house. And of course, the mortgage credit is very difficult still to get. And finally, there's still a fear of prices not going up, but potentially down, even though they've been rising recently. So people aren't as interested in purchasing a home simply to make a profit.
Okay. Great stuff.
Simon,
always great insight. Thank you very much. Tony Crescenzi of Pimco is an Executive Vice President there.